As the U.S. markets are closed for the weekend, this being Saturday, November 1st, 2025, we have a clear snapshot of Opendoor Technologies, ticker OPEN, which finished Friday's session at $7.70 a share. That was a huge move, up over 5.8% on the day. In the after hours, it ticked up another penny to $7.78. Now, the common expectation when most investors look at Opendoor, especially after the housing market turmoil of the last few years, is that this is a dead-in-the-water iBuyer. The narrative is that this is a simple, high-risk home flipping business that got caught with billions in inventory when interest rates spiked. Many people using Robinhood stock trading or SoFi Invest see this stock, remember its collapse from all-time highs, and assume it's just a zombie company. But the reality, and the reason you are seeing this explosive 5.8% move, is that this expectation is now dangerously out of date. The market is beginning to wake up to the fact that Opendoor is not the same company it was in 2022. It has survived the extinction level event, and the new management is executing a strategic pivot that is far more sophisticated than just flipping houses. The recent price action is all about this disconnect. The stock has been on an absolute tear this year, up over 400% from its lows. The 52-week range is a staggering 51 cents to $10.87. We are clearly trading at the high end of that range, which tells you a new story is taking hold. This isn't just a random pop. In September, the company announced a massive leadership shakeup, appointing Kazna Jadian, the former COO of Shopify, as its new CEO. This is not the resume of someone coming in to manage a bankruptcy. This is the resume of a tech operator brought in to build a high-margin, scalable platform. The market, which had given up on Opendoor as a failed real estate company, is suddenly being forced to reevaluate it as a technology company, maybe even an AI company. This shift in perception is everything. Co-founders Keith Rabois and Eric Wu also returned to the board, a move that, combined with a $40 million private equity injection, signaled to the market that the original visionaries are back and they believe the turnaround is real. Let's be clear about what is happening on the ground. The expectation is that Opendoor makes its living by buying a home for $400,000, doing some light repairs, and selling it for $420,000, all while hoping the market doesn't crash in the 90 days they own it. That was the model, and it was the model that almost bankrupted them. The reality of the new model is far more durable. Opendoor is transforming into a real estate platform, a marketplace. They are now aggressively partnering with real estate agents. Instead of just making a lowball cash offer, they are giving sellers options. They can take the traditional Opendoor cash offer, or they can list the home on the market with an agent, or they can use a new hybrid product. This distributed platform strategy is brilliant. It leverages their powerful pricing data and brand, but in many cases, it's now a capital-light model. When an agent lists a home, Opendoor takes a share of the commission. This is high-margin, software-like revenue. It doesn't require billions in debt. Their Q2 2025 results showed this pivot is already working, posting their first quarter of positive adjusted EBITDA since 2022. The recent stock movement is a direct reflection of this. That 5.8% jump on Friday wasn't on a whim. The company's Q3 earnings are scheduled for this coming Thursday, November 6th. The anticipation is palpable. What's driving the excitement is the news from 2 days ago that Opendoor is completely changing its earnings call format. They are calling it a financial open house and will be live streaming it directly on the Robinhood app, X, and YouTube. They are taking questions directly from retail shareholders. This is a massive, confident PR move. It's a signal from the new CEO that they have a good story to tell, and they are not going to hide behind a stale analyst-only conference call. Investors are buying in anticipation of this event. They are betting that the Q3 numbers will confirm the platform pivot is accelerating, that contribution margins are strong, and that the path to real GAAP profitability is in sight. For those new to the story, here's what Opendoor does. It's the pioneer of iBuying, which stands for instant buying. Their core innovation is a complex algorithm, now being supercharged with AI, that can analyze millions of data points to give a homeowner a fair market cash offer for their home in minutes. This eliminates the uncertainty, the repairs, and the hassle of traditional home sales. For years, they were a first-party 1P business, meaning they bought every home themselves, taking on all the risk. The new model is a hybrid. They still buy homes in their core markets, but they are now aggressively building out their third-party 3P marketplace, which is a platform for other agents and services. This is a much safer, more scalable business. It's the difference between being a single bookstore that owns all its books and being Amazon. I want to know what you think about this. Comment below with flipper or platform. Do you think Opendoor is still just a high-risk house flipper? Or do you believe this pivot to a capital-light tech platform is real? This is the central question for anyone considering an investment in this stock. Let's look at the future outlook. The bear case, the reality, is that this is all a head fake. The housing market is still on shaky ground. Interest rates are still high, and affordability is a massive problem. The bears and the analysts who have sell ratings on the stock believe that this new platform revenue is just noise. They believe that at its core, Opendoor is still tied to the cyclical, low-margin business of buying and selling homes. They'll point to the upcoming Q3 guidance, which consensus expects to be sequentially lower, as proof that the underlying business is still weak. They see the stock's 400% run and the new AI-centric narrative from a Shopify exec as a classic story stock bubble, no different from what we saw with Tesla stock or Nvidia stock in their early volatile days. They believe this $7.77 price is a selling opportunity before a return to reality. The bull case, the expectation, is that the market is just now catching on. The bulls believe the appointment of Kaz Najadian was the inflection point. He is aggressively pushing an AI-first mandate, forcing all employees to default to AI to make pricing more accurate and operations more efficient. The bulls see the financial open house on Robinhood as the opening salvo of a new era of transparency and confidence. They believe the Q3 report will show accelerating adoption of the high-margin marketplace and that the company will beat the lowballed EPS estimate of a 9-cent loss. They look at the Q2 contribution margin of 4.4% as proof that the core business is profitable on a unit economic basis. Anyone doing self-investing on Fidelity Investments or Interactive Brokers who believe this story is betting that Opendoor is successfully navigating the transition from a real estate company to a fintech platform. In the end, Opendoor at $7.77 is a battleground. The expectation of a failed, bankrupt iBuyer is being violently challenged by the reality of a new, tech-focused management team that is pivoting the business model to a capital-light platform. The stock's massive run-up and its 5.8% jump on Friday are the market's way of saying the old thesis is broken and a new one is being written. The company's earnings call on Thursday is not just an update. It's the public debut of this new story. The market is betting it will be a good one. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Bug Cashton. If you found this helpful, don't forget to like, comment, and share. Like, comment, share. Stay smart with your money.